we've seen some double-digit pullbacks in that area of the market in recent weeks. Are you looking to buy the dip? Are you looking to avoid? What are you thinking now?
The life science sector today is really mission critical and has only been able to address, 10% of the more than 10,000 diseases known to mankind.
All these companies have laboratories, they have office space, they have scientists, they've got electron microscopes, they got all these technological things that you can't do from a work from home standpoint.
They're learning painful lessons, and this real estate niche is unique and different for all others. He even refers to these dark life science properties as zombie buildings.
You could see, huge, mega market beating returns from this subsector.
Hello, everyone. It's Brad Thomas, and welcome back to the Wide Moat Show. I'm joined again this week with my co-host, Nicholas Ward. And Nick, it's great to see you today.
Yeah, great to see you, Brad. Happy to be here. Today, I think is going to be not exactly my wheelhouse, what we're talking about. So I might kind of just sit back and relax and listen to what you have to say, but happy to be here all the same.
Well, Nick, before we get going, I'm actually going to talk about a little baseball analogy. But before I get into the baseball analogy, I got to ask you about the football game, because I know every week a lot of our viewers want to know, how your team's done.
Yeah, we lost this week. We played the number one team in the region. They're undefeated. We were, it was 8-0 versus 6-2. The 8-0 team prevailed. It was 58-41. So 90, very high score, 99 points in a high school football game. We scored the most points, they've given up all year, but, I'm not very big into moral victories. A loss is a loss. So we're 6-3 right now, one more game left on the schedule. And if we win, we should go to the playoffs. So big week for us this week.
Great. Well, that's not good, but hopefully you make it to playoffs. Well, wanted to kind of dive into this. I just wrote an article on the widemoatdaily.com. So please tune into our widemoatdaily.com daily news. And I just wrote about the Field of Dreams. Nick, I'm sure you're familiar with that movie. Kevin Costner, and the phrase, if you build it, they will come.
Yeah, love that movie. Yeah, I've been watching the World Series all week. Great series with the Blue Jays and the Dodgers. Been thinking about, Bull Durham, Field of Dreams, Major League, all those famous kind of classic baseball movies. So, yeah, if you build it, they will come. I'm assuming we're talking about real estate this week then, if that quote's been on your mind.
Sure. Well, actually, I'm kind of using this in a little reverse language. The life science REITs, if you build it, they may not come. And what I'm talking about here today is the life science real estate investment trust sector, where we've seen a lot of new supply coming into this industry, but the demand has really pulled back. And that's, of course, created a pullback with a number of these REITs that we're going to be talking about here today.
Yeah, no, I know Alexandria Real Estate has been kind of top of mind for a lot of our subscribers. It's not a company that I follow all that closely anymore, but I do know I saw several comments in the comment section. So, Brad, happy to hear that that's your focus this week and happy to hear what you have to say. I mean, I know we've seen some double-digit pullbacks in that area of the market in recent weeks. So, are you looking to buy the dip? Are you looking to avoid? What are you thinking now?
Well, yeah, I think let's go into these individually because we got three companies and they all really have different risk tolerance levels. Some of them have more exposure to life science, some of them less, balance sheets, et cetera. So I want to go into each of these individually. Now, of course, the first one we're going to talk about is Alexandria, which is company's been around over 31 years. So a long, long time. They were the first REIT to capitalize on the biotechnology revolution. And we've really seen that revolution over the last, I've been covering the company now, maybe 15 years. This company was founded by Joel Marcus. I was actually going to have a call with him today. He's the CEO. He had to move that call back till later today. But they started out, again, Alexandria, and then he had a partner by the name of Alan Gold. Gold left Alexandria in 2004 and formed a company called BioMed, and we immediately picked up coverage of that company. They were, again, a publicly traded REIT. And then 11 years later, BioMed sold that business for $8 billion to Blackstone. So now you have Blackstone in the space, life science sector. You have Alexandria, and then Gold restarted, got back into the space again. He formed another company, private company called IQHQ, which is a private REIT headquartered in San Diego. Some of you may know Alan Gold from his co-founding and now chairman of Innovative Industrial Properties, which is an IIPR ticker, which is a cannabis REIT. So, but yeah, Alexandria's been around a long time. Obviously, there's two competitors that kind of indirectly spun off of Alexandria through management. And really the key driver for this space, and I've written about this extensively, but the life science sector today is really mission critical and has only been able to cure about 10%, or address, I should say, 10% of the more than 10,000 diseases known to mankind. So when I say it's mission critical, just consider this chart I'm going to put up here that'll show you this life science sector is really unique because we're seeing this oversupply in real estate, but this almost infinite demand for curing diseases. So look at here, 129 million adults suffer from one or more chronic diseases. 1 in 5 deaths are due to heart disease. 40% of individuals who will be diagnosed with cancer during their lifetime. And finally, 7.2 million people, adults over 65, have Alzheimer's. So this is a mission critical business. There's extremely high demand to cure all these diseases. And now with this advanced AI fuel technology, we've seen this wave, these catalysts forming that are driving breakthrough discoveries, accelerating drug development, and unprecedented insights into very complex medical challenges. Nick, just last week, I was on the phone. I work with this talk very closely with a family office down in Florida, and they just put some money behind a new clinical trial. They're in the third stage of this, and this particular drug is one that's supposedly going to cure the people who are addicted to cannabis. Obviously, we're seeing a lot of cannabis growth, and this is exactly why these properties are so extremely important.
Yep, that's pretty amazing, bro. I wasn't aware that cannabis addiction was even something you could treat. That's, I guess, to boil it down, that lack of awareness by me. That's why I don't pay a lot of attention, I think, to this sector, to the biopharmaceutical companies, the Mercks, the Bristol Myers, the Johnson Johnsons of the world. We track the big dogs in the space, but it's so hard to follow kind of this because I'm not a scientist. I didn't study chemistry. I didn't study biology at a a graduate level. When you read through these investor decks by those types of companies, I feel like if you don't really understand what's going on in a molecular level, you can't predict where the company's earnings are going to go. I don't know if that treatment you're talking about is going to work out versus a competitor's treatment. Just the science doesn't make sense to me. So that's why I don't like investing in this industry as much anymore. Like, I miss the Eli Lilly story. And when I missed that, I said, Nick, you just you're out of this space. If you miss that big of a trend, obviously I'm not paying well enough attention, but I do like it from the real estate point of view, because like you said, it doesn't really matter whether or not I understand the science. I don't need to know which company is going to win the race, which phase one, drug has, the best long-term potential. The fact of the matter is all these companies have laboratories, they have office space, they have scientists, they've got electron microscopes, they got all these technological things that you can't do from a work from home standpoint. And they need to happen to cure all of those diseases as you just talked about. So I do kind of like the idea of investing in this sector from the real estate point of view. If I don't understand the science, who cares? Let's just collect rents, from those laboratories. I guess that would be a way to boil it down. But I do know those companies have been struggling. So can you talk, why is that? Is that tariffs? Is that innovation? I know AI is getting into this space. Do you no longer need laboratories if, some supercomputer is going to be solving all these problems? What's the issue that they're facing, in Q3 2025?
Yeah, so going back to the title I mentioned, if you build it, they will come, or maybe they won't come. So post-pandemic boom in the life science sector, these developers began to increase new supply at a record rate. The decline in construction began in roughly the third quarter of 2023 and has accelerated significantly over the past 2 years. The construction pipeline peaked in the second quarter of 2023. I've got a chart here demonstrating. So when activity totaled 17% of existing inventory at that time, Now, as of the second quarter of this year, 2025, I haven't got the third quarter results yet, but as of the second quarter, the pipeline has contracted to just 3% of existing inventory, as that slowdown in construction gives the market enough time to absorb this vacant space. Now, it could take, Nick, a year. It could take 2 years. Nobody knows exactly. Now, I went kind of market by market. You can see here this chart. I mean, this decline is so significant in terms of construction. So very little construction. And companies like Alexandria, this is where we're going to focus on first, Alexandria. They got a little bit ahead of their skis here, or maybe a lot ahead of their skis. They built a lot of product. Now, they're in some great markets. In fact, I believe Alexandria has probably the highest quality portfolio in these hub city markets. You know, Nick, they locate these properties. A lot of these are located in college towns because obviously that's where their talent pool comes from. So you have markets like Boston or San Francisco, even Raleigh-Durham is another example. But I looked at a lot of these markets. You're seeing vacancy rates at some new buildings at 30 and 40%. So definitely we've seen that oversupply, and that is really one of the first things that's really created this environment. I'm going to give you a quote. I heard this on the latest earnings call. This is again Joel Marcus, who I'm going to be talking to later today, the CEO of Alexandria. He points out that a very low interest rate environment went along with that oversupply, which incentivized really foolish speculation by financially motivated real estate companies and their ever even more foolish capital partners. And Nick, he went on to say, this brought an unwanted and unnecessary oversupply to many of the innovation submarkets. This has never happened in this niche before, but they're learning painful lessons, and this real estate niche is unique and different for all others. He even refers to these dark life science properties as zombie buildings that will go and become in various different uses, obviously not life science. And he says the market will get tight and we'll be in a better position the next time around. So this is kind of where we are right now. It's a very much overly supplied market. I do believe Alexandria is in pretty good condition overall. We looked at their latest earnings results. Now, kind of backing up a little bit, Alexandria is the largest life science REITs. They've got 710 tenants in the portfolio, of which 90% of these companies in the top 20 list are investment grade or publicly traded companies. So they've got some significant credit behind this portfolio. And again, I mentioned the markets. They're in markets like these cluster markets, San Diego, San Francisco Bay Area, Greater Boston, New York, Maryland, and the Research Triangle. This is a picture I'm going to show you here of one of their mega campuses. So these aren't just one buildings. They have multiple buildings. So very high quality portfolio. Again, they're dealing with this oversupply. Let's look at the latest quarter where they generated $2.22 of FFO per share. That was reduced to about 25 cents, which is about 5%, negative 5% year over year. Now, the biggest news came out as a result of their 2026 guidance. This is what I think caught a lot of people off guard. They went ahead and guided for next year. Actually, they did that 2 days after the earnings were released. They guided $6.55. That's FFO at the midpoint. That's a 27% decline in earnings projections, because what they're going to be doing, Nick, is selling off some land. They've got a lot of land in the portfolio. Obviously, it's not generating any income for them. They're selling off some non-core properties to focus on these really high quality, what they refer to as these cluster markets. I'm going to show you the earnings chart that I put together here. You can see going back to 2008, they did have an earnings decline. By the way, they did cut the dividend. I'll show you that in just a minute in 2008, 2009, but they were able to continue to move this forward, move their earnings forward. You can see what happened in 2020. In 2021, coming out of COVID, their earnings really started to take off. They hit a $7.64 a share in 2023. But again, they've started to decline. And now you can see, based on this new forward-looking guidance that they've provided for 2026, we're going to see a pretty significant revenue drop. Now, that is likely going to impact the dividend. So here's what the company said on the latest earnings call. Actually, the CEO, Joel Marcus, said this on the latest earnings call. The cumulative growth in dividends and FFO has been highly correlated since 2013. Given the factors that we described in our press release that are expected to impact 2026 earnings and cash flows, we anticipate that our board of directors will carefully evaluate future dividend levels accordingly. Now, Nick, they didn't actually come out and say, they're going to cut the dividend, but you can see here from this chart, you can see their earnings growth, and we forecasted here about a 35% cut to that dividend, which would preserve about $315 million in annual cash flow. So yes, we're predicting here, and I think the company pretty much telegraphed a likely dividend cut ahead.
Yeah. So Brad, you're talking about the dividend maybe being cut. So I've got a couple questions because, on Wide Moat, people have heard us on this YouTube channel for months and months and months say, hey, if a company cuts a dividend, it's probably a stock to avoid because generally speaking, when dividends go lower, share prices follow. Looking at Alexandria's long-term chart, I have the fast graphs here pulled up on my computer. I see, yes, they cut it post Great Recession, like you said, but then over the next decade, the stock took off and the dividend followed. So two questions, I guess. One is, do you think this is a unique kind of example of, every rule is meant to be broken? And even if Alexandria cuts the dividend here, if they're setting themselves up for growth in the future, it's something maybe you should consider buying. The yield's at 9% now. So if they cut the dividend, it's still going to be a pretty good yield. I mean, I know that's kind of the yield trap mindset that we tell people not to fall into, but fundamental growth will drive the dividend long-term. And it sounds like you believe this company can get back to growth kind of once the supply thing figures itself out. But I guess to that point, second question, I know the management's talking about these zombie companies, kind of these other companies encroaching upon their market share in these cluster markets, which they've dominated for decades. Is this the pot calling the kettle black type thing going on here? I mean, like they probably overbuilt too, right? I mean, I know their year-over-year rent growth just a few years ago was very strong double digits. We're talking 20, 30%, some of the best that I've ever seen. So I wonder, like, did they get greedy too? I mean, you see rent growth like that happening. I'm sure you want to build out as fast as you can. I wonder, like you said, they got above their skis, but it almost seems like it's unfair to blame the competitors when they're doing the same thing. So those are my two questions. One, do you think the company is headed for growth, or is this an excuse kind of blaming the competition in these niche markets? And then two, say the dividend cut does happen, what does that mean for ARE stock moving forward?
Yeah. So first, I'm going to address one of your last questions first. And that kind of goes, we'll talk about the competition in just a minute because there's two peers in this space. But what I will say, there's a lot of other competition in the market, and that's the subleasing market. So what's happening, this dynamic of these bigger companies are now subleasing space that they don't need, or they're pulling back due to the government shutdown, by the way, is closed down the FDA. So it's not only slowed down the capital flows into the space, it's closed down to getting these approved through the
U.S. government's one of ARE's largest tenants, I think. You talked about that top 20 tenant list. It's on there.
Yeah.
So I wonder how that's going to go for this quarter, really.
Well, again, that's a whole lot different story, and I plan on writing about that this week, the impacts of this government shutdown. The ripple effects are really starting to get bigger and bigger. But anyway, this sublease market is really other competition that all these life science REITs have, and they're renting this space out. So they're not only competing with the existing space that they've rented that they can sublease, but also their new product. Now, back to the dividend. I'm going to break a rule, and I normally don't break rules. And my rule, many of you have heard me say this before, is a dividend cut is never priced in. Okay, and I've said that before. I know you've heard me, but I'm going to break this rule because I think for Alexandria, I think we've already priced in this dividend cut. Nick, you mentioned your fast graphs. I'm going to pull this up now. You can see now shares are trading at 7.9 times price to AFFO compared with their normal, whatever that means, normal valuation of 20.8 times. Now the dividend right now is 9.1%. Now again, that's very likely that's going to be cut. My estimate is about 35%. Put us down to about a 5.5-6% dividend yield based on current earnings. But again, we're going to have those earnings decline next year. We've already been told that by the management team. So we're definitely looking at this pullback. The question is, what's going to happen over the next 12 months or 24 months? I think you've got to be in this thing for the long haul because a number of these zombie buildings must be released. But in terms of valuation, I really think this is an attractive setup. And if you can hang on and you have the patience, I think this particular company, this REIT, could return 50% annualized returns I'm not going to say over the next 12 months. That's annual returns, but I think it's going to take 24 months until this product gets absorbed. Interest rate cuts. We haven't talked about that, but we already got the second cut now. We're going to probably have more. Obviously, we don't know for clarity we're going to have a cut in December, but I think we'll definitely get rates down further, which is certainly going to improve the cost of capital. We'll get the government back to work. And most importantly, we'll get VC funding back. Again, I mentioned I've got a good friend who just raised money through this multiple family offices for this brand new drug in the third phase of the clinical trial, which I think will be a very successful opportunity. So that's the return setup that I believe we're going to see here with Alexandria. Now, the next one I want to jump on is a little more speculative. And this company called Kilroy Realty. Again, I've been covering this company for quite a long time. They are primarily focused in California, Los Angeles, San Diego, San Francisco Bay Area, Seattle, and then a little slice of Austin, Texas. They own 121 office buildings and they have 428 tenants. Now, just 17% of that revenue is considered life science or healthcare related. And they also have some apartment exposure, some mixed use retail exposure. So again, it's not a significant part of their business model, 17% roughly in healthcare and life science. You can see their tenant list I put here. It's comprised of a lot of different companies, a lot of technology customers. You might imagine Stripe, Adobe, LinkedIn, Netflix, they even have DoorDash in the portfolio. So this is a more diverse business model. Again, not as much focus. Their life science properties seem to be performing fairly well. Again, but you've got primarily this West Coast exposure. Now that could be helpful in terms of there's a lot of venture capital firms who have offices and obviously are going to remain in California. So I think that's certainly an attractive part of their business opportunity. Now, one of the things that concerns me, they got this one property here. It's called the Flower Mart. It's in San Francisco. I'm going to put an aerial photo here. Originally, they proposed to build 2.5 million square feet of office and retail on this property. Again, it's San Francisco, so they really had to punt this one. Now they're trying to look at some redesigns, given the higher occupancy rates in San Francisco, which is about 35% higher occupancy rates. So this is a chart they actually put together a few weeks ago. It shows their anticipated different uses or versions of how they're going to try to redevelop this property. So this is still in the very early stages. It potentially is a $500 million investment. Again, that's a pretty high risk development deal for Kilroy, again, in California and in a market like San Francisco. So again, I want to point out, I think this one's got a lot more risk than the others. Let's look at their earnings. You can see they actually have fairly decent earnings coming out of, again, like most REITs, they did get devastated in the Great Recession, but they were able to build back their portfolio up to a record of $403 a share in AFFO. But again, now that's declined. And again, consensus doesn't look very favorable for 26 either. A pretty big drop. Next chart I'm going to show you is the dividend chart. Again, they've been able to grow their dividend, but over the last 4 years, 3 to 4 years, they maintained a flat dividend. And most importantly, I like to include these payout ratios, especially when we get to this dividend danger zone. And you can see the company is now moving closer, to a sucker yield. Their payout ratio, if the analyst estimates are correct, they could be at a payout ratio of about 80% next year, 2026, which is pretty dangerous, especially because you're an office REIT and you've got considerable CapEx. So I'm going to show you the fast graphs on this one real quick. Again, the valuation, there's no argument this company's cheap. They're trading at 12.6 times. Again, you've got to consider that geographic concentration risk. Their normal valuation is about 25 times. So roughly about 50% valuation normal. Their dividend yield is 5.1%. Again, that's going to become more dangerous going forward as their earnings decline. So I would be careful with Kilroy. I think that one is definitely a higher risk REIT with a modest exposure to life science. The final one I'm going to address here, and Nick, you and I have talked about this quite a bit. This company is Healthpeak, ticker symbol DOC. They're a leading healthcare companies. They're on medical office buildings as well as life science and about 15 senior housing properties. This portfolio is about 49 million square feet. It's again, 50% of this is roughly medical office. So about 36% is life science. Now, one of the things that I found interesting with DOC or of Healthpeak is that they really did not go overboard with development. They really slowed down their development activities, which has really been beneficial for them. And one of the reasons I think they will continue to not only maintain their earnings and their dividend, but potentially grow it. This is their customer list. You can see it's a very diversified, customer list. A lot of leading healthcare companies and large cap biopharma companies. So I like the diversification. They've executed about 339,000 square feet of life science leases in the latest quarter. It's the third quarter, of which 45% were new and or renewals. So they've achieved a positive 5% re-leasing spread. So they've actually, again, done fairly well through this cycle, this oversupply cycle that we've seen. Their leasing volumes totaled about 1.1 million square feet, and the company ended the quarter with total occupancy of 81%. I want to give you this quote on the latest earnings call. Scott Brinker said, "The regulatory chaos and uncertainty that existed in the first 6 to 8 months of 2025 had a big impact on sentiment in the sector. Obviously, investors making capital commitments are looking for certainty in terms of their environment that they're investing into. And we just didn't have that for the first half of the year." Again, they've been a lot more cautious, a lot more conservative. And in terms of earnings, they generated about 46 cents per share of FFO, 42 cents in AFFO per share. And their same store growth was about 3.8%. Leverage is in great shape, about 5.3 times net debt to adjusted EBITDA, with about $2.7 billion of liquidity. Now, I'm going to show you this AFFO chart here, but I want to remind the audience that Physicians Realty merged with Healthpeak in 2024. So I know the earnings chart may look a little skewed. So all I'm really interested in are those light shaded areas in 2024, 2025, and of course their forecast in 2026. So they look like they're in fairly good shape with their earnings. We're not going to see a decline. And again, this is the dividend chart. They've been paying about $1.20 a share since the merger. Again, this is the final chart I'll show you on Healthpeak, or not the final, but one of the final charts. This is their payout ratio, about 73% payout ratio. So again, I don't see a dividend cut here. I think this company still has a good bit of value. As shown on this next chart, this is your fast graph chart. We've got a 10.7 times price to adjusted funds from operations compared to a normal valuation of about 15.8 times and a 6.8% dividend yield. So kind of summing up those parts. And by the way, I think this company could deliver somewhere in the range of about 25% over the next 12 months. Again, they don't have 100% exposure to life science, and they've been more conservative in terms of their development activities over the last 2 to 3 years. So again, some of those parts. Alexandria is a very attractive opportunity, could generate potentially 50% returns. Again, this thing sold off pretty massively. And again, I think the dividend is pretty well priced in. I think there's a great opportunity to jump back into Alexandria. Now, Healthpeak is a lot less risky. Again, less exposure to life science. And again, well-covered dividend, great balance sheet, investment grade. I think that's also a good opportunity for the less risky investor. And then Kilroy, again, is very speculative. Unless you love California, I would probably put the brakes on that one. So anyway, Nick, that's going to sum up the life science show today. And let me know if you got any questions.
Yeah, no, I'm sure there's viewers that are happy you did this. People have asked me about this space because these valuations are, we're talking like Great Recession trough type multiples. ARE hasn't traded for this prices since 2009. So I get why people are interested. My response is, I don't feel compelled to own everything. I don't need to have exposure to medical office and or life sciences in my portfolio. I can sleep just fine at night, focusing on kind of, my wheelhouse, my highest convictions areas in the market. But, as far as like a deep value investment goes, yeah, ARE does look interesting. It's not really my style. I doubt it's something I'm going to put my personal money behind, but I can certainly see why somebody would. Like, I'm sure Chuck Carnival is looking at that chart, and just licking his lips. That definitely has kind of Mr. Valuation written all over it. Maybe not, Nick Ward written all over it, but I certainly wish people the best of luck with these types of companies. Because like you said, if, ARE's, I just looked at its 10-year average multiples 24 times. It's trading for 7 times right now. So, I mean, you can get 100% returns and still be trading at a 50% discount to the long-term average just about. So, very interesting. I'll be watching it probably from afar, but good luck to anybody that likes this space. And, I'll certainly be rooting for multiple expansion to occur, because I think Brad's right. You could see, huge, mega market beating returns from this subsector of the REITdom.
Yeah, and I'm looking forward to speaking again later today with Joel Marcus. I was hope to do it this morning, but I'll be providing updates along the way. And again, this is a great pick. I am going to show you this last chart. This is all the healthcare REITs we cover now. Through Kilroy in, it's really not a healthcare REIT per se. They've got healthcare and life science exposure, but I wanted to show the audience kind of the entire healthcare spectrum, which again includes skilled nursing, senior housing, medical office buildings, hospitals, et cetera. So there's a very large, diversified universe for healthcare REITs. You're right, Nick. I mean, life science is just one of those areas. But again, that pullback, this oversupply has created an opportunity. And again, you want to own the companies with the most dominant, moat advantages. And I definitely think Alexandria, checks all of those boxes. So, Nick, I want to thank you for joining me today. And I want to thank everybody here who's watching for watching us today. Please drop us any comments below, because we'll try to continue to answer questions. I've got a list forming of ticker symbols. We'll try to keep covering as time goes on. And thank you for joining us today. Have a great week.
Yeah, thank you guys. See you next week.
Hi, everyone. Thank you for watching today's episode of The Wide Moat Show. Please comment, like, and subscribe below, or go visit us at widemoatdaily.com. As always, happy swan, sleep well at night investing.